Good evening and welcome to our December Natural Resources webinar brought to you by focusIR and London South East. For those of you who don't know me, I'm Donald Leggett, Head of Media at focusIR, and I'm your host for this evening. We're delighted to welcome four excellent speakers tonight with a collective focus on mining and mining royalties. Finally, we're joined by Christopher Nicholson and Renas Sidahmed from ACF Equity Research, and they're going to be talking us through China's dominance of rare earths. China currently produces 57% of the global REE output. Chinese market dominance is a global strategic concern because rare earths are essential materials for electric cars, defence applications, wind turbines and solar panels. ACF Equity Research have recently published research on the rare earth elements market, and they'll be giving us their views on rare earth metals as an investment later. If you want to see that research, it's available as a link on the chat board at the bottom of the screen. Each speaker will speak to slides for 18 to 20 minutes before you take your questions and put them to speakers for a further 10 minutes. Some brief housekeeping for you. You may have noticed we've rebranded. focusIR as London South East's new digital investor relations arm. We continue to distribute our content on London South East, of course, and more recently on Research Tree and Armchair Trader, amongst others. And to describe what we do, briefly, we work with client companies independent from, as well as alongside existing advisors to provide investors with all the key information they need. So there you have it. As ever, many thanks for joining us tonight, and it's time to hear from our speakers. Trident Royalties is a growth-focused, diversified mining royalty and streaming company, and it provides investors with exposure to a mix of battery metals, precious and bulk metals. The acquisition and aggregation of individual royalties and streams is expected to deliver strong returns for shareholders, as assets are acquired on terms which reflect single asset risk compared with the lower risk profile of a diversified larger scale portfolio. The share price is currently 36 pence, around 36 pence. The market cap is around £105 million, and brokers Liberum have a target price of 77p currently. CEO Adam Davidson joins us live from Denver in the United States. Welcome, Adam.
Hi, how are you?
I'm excellent, thank you. It's fantastic to have you joining us on our webinar, kicking our webinar off. Now, what do you want to tell us about tonight, Adam?
Yeah, I'd like to touch on the business model just briefly, and then primarily focus. As you said, we've done 5 transactions this year, and then most recently just announced an updated debt facility, which helps us grow the business. So a lot of recent active news that I think would be worthwhile to touch on.
Fantastic. Over to you then, Adam. We're looking forward to this.
Great. I just flag this is by and large the same presentation that's on our website. So the disclaimer and all these slides will be available for people to view separately. As Donald mentioned in the intro, we're a mining royalty company listed on the AIM market in London, and also have an OTC listing in the US, which we did this year, and it's seeing increased volume as we go. But really the intent is to build out a diversified portfolio of mining royalties from which we derive income. So just very briefly with regards to sort of background on the business model itself, you can see here the benefits of mining royalties relative to investing in mining equities or investing directly in mining physical commodity, whether they're ETFs or other instruments. And really the key thing for us is that if you hold a royalty over a mining property, as it produces and sells material, we get a percentage of the revenue that's derived from that property. So not dissimilar from investing in mining equities, except the big differentiator is we get top line revenue of the P&L. So we're just getting a cut of their revenue. Whereas if you're investing in mining equities, effectively your exposure is at the bottom line of the P&L. So you're getting a cut of profit. And I think what we see in environment like we're in today, gold price, for example, is streamed up to all-time highs recently. It's still north of $2,000 an ounce. So the gold miners should be making good money. However, they also are facing inflation with regards to their costs, paying more for labor, paying more for diesel, those sorts of things. So what you may find is although commodity prices may be strong, the actual profit margin of the mine operators may be the same as they were last year. They may even be tighter than they were last year. Well, royalties avoid that sort of risk in that we get exposure to just their revenue. So if they're year on year producing the same amount of metal and the price goes up and we get 1% of their revenue, then we benefit from that upward price environment. And yet we still get the asset level exposure, which is the reason people invest in mining royalties versus simply just investing in metals ETFs. The metals ETFs aren't linked to specific assets, and in mining, 80+% of assets that commence production either extend their mine life or expand their planned production profile. So it's that sort of asset level exposure that you still get with a royalty, but you're protected from the cost side of the equation. So that's the business model in a nutshell. And then if I just jump ahead to highlight the style of exposure that we're providing, you'll see that I'm skipping through a few slides, so please go to TridentRoyalties.com and review this in more detail, but I'd like to leave as much time as possible to talk about our new transactions. So what this slide highlights is the breakdown of our portfolio as we stand today. A couple key things to flag here. We've been listed for just a little short of 3.5 years. When we listed, we had just a single iron ore royalty on an asset in Australia. It's been a great investment for us. But we had just one single royalty, so we weren't exactly offering sort of diversified exposure to the entirety of the sector. But if you fast forward to today, we've now got 21 assets, 13 of which are cash flowing. You can see the analyst consensus estimates of our net asset value by commodity on the right side of this slide. Effectively, 40% of our exposure today is in lithium, spread across a few assets, with about 30% of our exposure in gold and then 20% in copper. The balance is spread across silver, iron ore, and mineral sands. In fact, you can see that initial iron ore royalty now represents less than 2% of our overall net asset value. So we've been pretty pleased with the progress to date with regards to spreading out the diversification of the portfolio, because that really is the key objective. Now, just jumping ahead to a couple of our transactions for this year. Our most recent was on a copper royalty, which we were really pleased to get. It's hard to get good copper exposure, and what we think we found here is an asset that is, one, located in a very good jurisdiction within the U.S. in Arizona, which is a mining-friendly state, produces most of the U.S.'s copper output. The project itself is located on a brownfield site. That means it was a copper mine previously up until sort of the 1970s. The operator actually owns all the surface land where there would be surface infrastructure, which streamlines the permitting process. And effectively, we put a royalty over top this property. It's at the sweet spot with regards to development timeline, where they intend to publish their pre-feasibility study before the end of the year. And that kind of marks, roughly speaking, the midway point of a mine going from exploration to end production. So, they've done their scoping study. We priced our deal on the scoping study economics, and it stands up very well. It's a good return profile. But they'll publish the pre-feasibility study here shortly. And then from there, you kind of move on to the final feasibility study. And then that really triggers the process to commence fundraising to actually build the mine. So we're sort of sitting between scoping study and feasibility study with the pre-feas sort of imminent. We find that that's a really sweet spot with regards to where we can find value. Obviously, if an asset is in production, what you tend to find is that you have to pay up to secure a cash flowing asset. People don't want to let those go cheaply. And if the asset's too early stage, it's in the exploration stage, then that the clarity to when it will be in cash flow is pretty long dated. And we find that our investors, they want something that is right in that sweet spot in the middle, where we've got good clarity of what this can look like. In this particular case with Antler, based on the scoping study, it's a 13-year mine life, producing 33,000 tons of copper equivalent a year. So as it stands today, has the size and scale to be a mine, but then we expect it to grow as they do more drilling and as they publish subsequent studies. And yet we still have that clarity to cash flow. Hard to read, but you can see the Gantt chart in the lower right. This is from the operator's presentation. They flag pre-construction activities commencing in, sorry, I see the slides didn't advance. You can see that the Gantt chart in the lower right flags pre-construction commencing in the first quarter of 2025. Now, obviously, when we're doing our analysis, we flex the dates at which we see the asset turning on, but I think we put that in there really just to highlight the fact that that the asset is very much focused on moving towards a construction decision. So really pleased to have added this one to the portfolio. So Antler was announced in November. The slide that I'm showing now is on the Paradox Lithium royalty. We acquired this one in September. We've been exceptionally active here in the back half of the year. In this particular case, the royalty is over all properties operated by Anson Resources in the Paradox Basin, which is a huge area which covers a chunk of Utah and Colorado. And in fact, Anson Resources, a good ASX-listed operator, has 3 projects within the Paradox Basin. But the most advanced is the Paradox project, the lithium project. I flagged the sort of stages of a project when I was speaking earlier. And in this case, the asset's more on the advanced side, so it's done its sort of scoping and pre-feed stage. And in fact, last year they published their feasibility study. And they're working on a final feed study now, which is kind of the last step before you pivot to sort of a construction decision. So this one's, as we see, an advanced stage lithium brines project. It's in fact DLE, so direct lithium extraction. Some of you may have noted that Exxon recently announced a similar project in Arkansas in the Smackover Formation, which would be using similar technology. So this is sort of an earlier stage technology. There is lithium that is produced via DLE. I think about 35,000 tons of lithium were produced last year, but it seems to be growing in the sector. So we were really pleased to get a royalty over an asset in the U.S. that's at advanced stage and utilizes this technology as a way for our shareholders to get exposure. The other thing I'd flag on this particular transaction is in the lower right, you can see the deal structure. There's a $10 million headline deal, but we only put down $1.5 million up front to secure the royalty. The second tranche is due once the asset has hit commercial production. And the third tranche, which is a full 50% of the consideration, isn't payable until 2 years after the second tranche. So it allows us to get a lock-in exposure to an exceptional quality asset. We flag in here at $25,000 per ton lithium. It would be spinning out $8 million a year to us as the royalty holder. That's based on the DFS. It's got a 23-year mine life. The resource has increased twice since they published that DFS. Most recently in October, the month after we bought the royalty, the resource was increased by 40%. So that's a much larger project. We expect the feed study is going to relay a project size that's in excess of what we saw in the DFS. Which is what we predicated our economics on. So again, really pleased to get this one into the portfolio. And I might just skip over the next couple slides and jump down to our balance sheet in the interest of time and to leave a good amount of time for questions. But we have done a number of deals this year. That said, we still have some capacity within the company. You'll see on here that our most recently reported cash balance was $25.6 million US. We've done a slew of deals. And the most recent Antler isn't taken into account in that number, so we spent roughly $7 million US. So still got a good amount of cash within the portfolio at circa 18 million post-transaction on Antler. And then importantly, last week we announced an update to our debt facility. This is a pretty critical step for all royalty companies as they grow. We had 40 million outstanding with Macquarie Bank as a term facility. So what that means is we drew down the full 40 million, despite the fact that we're sitting on cash, we're paying interest on that full 40 million, and we don't have the flexibility to sort of pay it down and redraw it. And we're paying a coupon of 5.75% over SOFR. Whereas the new facility that we announced last week and that we're hoping to conclude documentation on in the first quarter of next year, sees the coupon step down from 5.75 over SOFR to a grid of between 2.5% to 4.5% over SOFR. It depends on our net leverage ratio, but we think we'll be operating in the kind of 3 to 3.5% range, generally speaking. So that sees an immediate savings, a pretty significant savings. And then on top of that, the new facility will be a revolving facility. So instead of having a full 40 million drawn and then sitting on 18 million in cash, we can effectively pay down the facility so that you're not paying interest on the undrawn portion. You only pay a small sort of standby fee on the undrawn portion. So that also leads to pretty significant savings. The final thing to flag is that that facility also had a $20 million accordion feature, which means that you can increase the size of the facility for new transactions that still stay obviously within your covenants and leverage ratios and so on. But it provides another sort of lever for us to make acquisitions, like I flagged with the Paradox acquisition. that was a way for us to deploy a small amount of capital, but secure a meaningful royalty in the portfolio. In other words, a means for us to stretch our balance sheet as much as possible to grow the portfolio without undue equity share capital dilution. We believe that the debt facility, in addition to being lower cost, offers a bit of optionality in that regard as well. So we're really pleased to get that over the line. And I think with that, Donald, I'm happy to pivot to questions.
Okay, Adam, thank you very much. That was excellent. And you have had an exceptionally busy 2023 in terms of acquisitions and so on. So I wonder if I could ask you, to what extent has the difficult equity markets actually been a bit of an open door for you in terms of actually getting those acquisitions over the line and potentially into 2024 as well?
No, that's right. It's as you said, been incredibly busy for us. And apologies, my screen dropped off here, but if I can pull up the presentation one more time, I'll flip to our share price chart. It's obviously nice to flag a share price that's sort of moving up and to the right. When we listed it, we were at 20p, as you flagged earlier. As of today, we're at 36p, so we've seen good growth in the share price over the last few years. But more importantly on this chart is the sort of sheer velocity of transactions. I think people generally like the royalty model and they like what we're doing. Most of our peers are focused on precious metals. As I said, we've got lithium, copper, iron ore, mineral sands, looking to sort of continue to expand that diversification. But sort of the natural question that we get is, are there deals out there to be done? The strategy seems very intuitive. Why are others not doing this? And to be fair, there are a couple, but there's not very many. And so a market like we're in today, despite share prices being hit hard, including ours, this is sort of down for the year. But what we're finding is that mining companies themselves don't want to go out there and raise equity in this kind of environment. Either the capital is not available, institutional investors have fund redemptions, they're not deploying capital. If anything, they're pulling back capital. And so the time is really right for a royalty company to layer in royalties on good projects. And then inevitably, when the cycle turns, we'll be sitting pretty, because it's environments like this where you can secure good deals, get good quality royalties into the portfolio. In frothier markets, those opportunities just aren't as readily available. So we're pretty pleased with where we're standing at the moment, well capitalized and well positioned to take advantage of where we are in the sector. And yeah, as you said, of those 5 transactions, 3 of those are just in the last few months. So it's been an incredibly busy time for us.
Well, and let's be mean and ask you about 2024 then. Are you expecting to be as busy next year as you have been in the last 6 months of this year? Well, I suppose 2 acquisitions in the first half, 3 in the second half. But will you be that busy again in 2024? Or, hey, you tell us.
Yeah, it's always deal dependent. I'd say the pipeline at the moment is as robust as it's ever been. I think the couple reasons for that. One is, as we've gotten larger and better known and done more transactions, we're on people's radar in a way that we just weren't sort of a couple years ago. Even just announcing the debt facility last week, that's being provided by a couple of big Canadian commercial banks, BMO and CIBC. It's things like that get you on people's radar, and flagging access and availability of capital. So, if you're a mining company and your share price is down 30, 40% for the year, you're not in a rush to go to the equity markets. That said, you can't sit on your hands and not advance your project. So I think, we're seeing quite a few people that sort of script is flipped and they're knocking on our doors more than we're previously where we've been knocking on theirs. So always subject to sort of deal flow and getting things over the line. But yeah, we anticipate 2024 to be a busy year as well.
Okay. Ian McGurty, thank you for your question, Ian. He asks, how is Thacker Pass profitability looking at current much lower lithium prices? So I suppose there's a theme there, isn't there? It's useful to ask you about the lower lithium price. You told us that what you said, you have, of your 21 assets, 40% is in lithium, so it's a very appropriate question for you. How have you been affected by the lower lithium price, and talk us through Thacker Pass and how that looks even at a lower lithium price?
Yeah, no, that's a good question. So I flipped a slide that incorporates a quick synopsis of Thacker Pass. For those not familiar with Trident, this is one of our key assets. Depending on your view on lithium price, probably 25-ish to 30% of our net asset value is directly linked to Thacker Pass. That said, this year has been an exceptional year in that some big milestones have happened at Thacker. The permit was upheld on 2 occasions, and it's now sort of permitting is effectively done. It's in construction. The operator flagged that they're putting $145 million in the second half of this year, and that number is going to accelerate next year as they accelerate construction. And then the other aspect is that General Motors, they're coming in as the largest shareholder of the operator, putting in $650 million towards construction, and they'll be taking the offtake of the stage 1 lithium production and have the right of first refusal over the stage 2 expansion. So to answer the question directly, you'll see a snippet there. At current lithium prices, or sort of thereabouts, I think it's dipped a little bit since then in the last week or so. The royalty, once fully up and running, would pay about $21 million a year to Trident. Important to flag that that's a 40-year mine life, over $500 million. If prices sort of stay static, would pay us as the royalty holder over $500 million. And again, as the royalty holder, we're not operating the mine. We don't have costs associated with that. We may audit them from time to time, visit site occasionally, that sort of thing, but there's really no cost. That revenue starts flowing in, commencing, they're targeting the second half of 2026. And then from there, that revenue rolls in. And then I think the real key thing to flag is that lithium is not an exchange-traded commodity. I think as we see the rise of EVs and general battery storage for renewables, there are going to be years where lithium sort of skyrockets in demand. We saw that last year. Prices reached up to $80,000 a ton. The royalty at those prices would be paying us circa $60 million a year. And then you've got prices where it's lower, and the numbers are going to be more like 20. But with a royalty like this and a tier 1 asset that is low enough cost and has good tier 1 operator and good tier 1 off-takers, that asset is insulated from sort of those swings. And that's a key part of our diligence for all assets is, are they defensive enough to survive the cycles that we inevitably see in mining? I think Thacker Pass is a globally significant tier 1 asset, so it can weather those cycles. And then there are those years where we're going to make hay.
Okay, I've asked you this question before, but it is really interesting. What other elements might you be looking for to keep the portfolio diversified? And would you buy the deal opportunistically? Would you prefer to buy the deal because it was a great deal, or would you really be quite rigid and stick to that? No, I must diversify the portfolio, otherwise it's not going to be balanced as we hope it would be.
Yeah, it's a question we get pretty often. I think for us, we're still at the stage where the best deal wins. We've certainly taken into account, we'd like to broaden the commodity diversification. But frankly speaking, would we take a lower IRR deal in a new commodity versus a higher IRR deal in a commodity that we have current exposure to? It's all deal dependent, but I think at this stage in our growth, we want to get the highest returns possible. And what we've seen is that the portfolio naturally starts to get more diversified. You can see that just over the last few months. We did a copper deal in November. This should flag it. It's copper zinc. It's a polymetallic deposit, so it's got some meaningful zinc exposure as well. In September, we did a lithium deal. In August, we did a gold deal. We weren't trying to cherry pick commodities there. We were just doing the best deals that were available to us. So I think that will continue to be our guiding principle. That said, if we see something that's a commodity that we really like and want to get into the portfolio, it naturally sort of pops up onto the radar in a slightly different way. So I think it's deal dependent, but by and large, it's still focusing on quality of deals above all else.
That polymetallic deal was a great example of nature introducing a degree of diversity all by itself. You got copper, zinc, and some other elements all in the same deal, didn't you?
No, exactly. Yeah, we're pretty pleased with that. It's about 50% copper revenue, 38% zinc, and then the balance is lead, silver, and gold. So yeah, through that one royalty, you're getting exposure to 5 different commodities.
Okay. Let's talk about the $40 million revolving credit facility with BMO and CIBC. So who are those lenders, and why is it so fundamentally important to you? This is something you've been working to from the moment you started, getting your cost of capital down so that you can then do cheaper and more effective deal making.
No, exactly, and you really answered it there in the latter part, because that's the gist of it. If you, we've got a cost of capital. There's our cost of equity, what our shareholders' return expectations are, and then there's our cost of debt. And that blended cost is our weighted average cost of capital. And really, where we can arbitrage the space is to go out there and provide capital to mining companies either buy their pre-existing royalties that they hold on other properties or provide them financing directly to help advance the project at a cost of capital that's obviously higher than our cost of capital, but lower than their cost of capital if they're evaluating raising equity or whatever. So that's really the gap. So the key thing for us is that with that new debt facility, we're lowering our cost of debt. So in a time where interest rates are high, share prices are down, so cost of equity, cost of debt is higher for the miners themselves. In fact, our cost of capital has been reducing now. We lowered it 2% earlier this year under the Macquarie facility, and we just lowered it again over 2% now with this new facility. So we're reducing our cost of capital, which means that we can be more competitive when we're offering royalty financing to the mining companies. We've now got lower cost of capital, so we can pass through some of that savings in part and offer them more competitive sources of financing effectively.
Okay. And BMO and CIBC, now you said in your RNS that there were lenders to the mining industry. So tell us a little bit more about them. But you didn't quite use the partnership word, but I was amazed at the language that you used around that. It was as if you were doing it together. And it was an interesting language to use in terms of a banking facility. They were almost your partners in business. Tell us about that relationship.
Yeah, those are two big banks. They lend to other royalty companies and lend to the mining sector. Resources is obviously a big portion of the TSX, the Toronto Exchange. So being Canadian banks, they know the space. I suppose with regards to kind of that element of partnership, I think that's true. You document these things ad nauseum. You go into real detail, obviously, when you're documenting a $40 million debt facility. That said, it does sort of boil back down to trust. As most of these things do, that we're going to manage the business appropriately. We're going to keep them informed. So I think we do view it in that sense. We'll do things per the documentation, but I think we want to view this as a partnership. They've got investments in companies, can make introductions. We can facilitate growing the facility as we find new leverageable deals. So it behooves us to treat it that way. So I think it really is a step change, and it's hard to articulate for people that don't know these banks, but the fact that they're very active in the royalty space and mining space more broadly, I think it is there's the cost savings element to it, the flexibility of a revolver, but then that partnership element is hard to articulate, but it is very meaningful as it impacts our day-to-day business.
That was a great answer. There you go. I think you articulated it very nicely. Thank you indeed. So let's turn to Oz Williams. Thank you very much indeed, Oz, for your question. It's another Thacker Pass question. Is Thacker Pass reaching production the dividend decider? So will that be the moment that you decide to pay a dividend? Asks Oz.
Yeah, I'll flip this. The slide I'm showing now is one of the research analysts that covers us, their revenue profile. Of Trident. A couple of things to flag here to sort of indirectly answer Oz's question, but the dark blue bar that you see sort of growing there, that's currently cash flowing assets. We've got a number of assets that are cash flowing, 13 of which, and some of those are either in ramp up at the moment. They've just recently commenced production and are accelerating and ramping up. Others have sort of expansions that are underway. So we'd like to flag that, the revenue that's currently from currently operating assets, we should see over the next few years sort of a 50-60% uplift in revenue from those assets that are currently operating today. So in other words, it's sort of very safe form of growth. And then the light blue are on assets that are like Thacker Pass, either in construction today or very, very near term. So again, that's a differentiator, because I think a lot of investors probably see revenue profiles that are sort of moving up and to the right, but ours is very tangible in that a lot of growth is coming from currently cash flowing assets. And then a lot of the growth on top of that is from assets that are in construction and are going to turn on and start generating revenue. So to Oz's question, I think you can see in 2026, and then we don't highlight 27, but other assets are intended to turn on. And in fact, what you see in 26, Thacker Pass only turns on its stage one in the second half of 2026. There's not actually that much revenue from Thacker in that part of the bar. It continues to grow as they ramp up, and then as they move into phase two production as well. So that at the moment is sort of the catalyst where you see the revenue really sort of skyrocket, and it's only a matter of time. I suppose the key thing to flag is that this is the revenue profile we built in the last sort of 3+ years that we've been in existence here. The intent is to not stop now. We did 5 deals this year. We want to continue to increase those bars on this chart, bring forward revenue and bring forward the date at which we can commence a dividend. We all recognize that that's going to be a good date for the share price when we can commence a dividend. But we want to do it at the right time and ensure that the cash flow that underpins that dividend is secure and that there won't be any changes to the dividend policy once we commit it. So it's a bit of a balancing act, but yeah, I think it's probably safe to assume that once those assets turn on and we've got a bit more certainty that as we stand today without doing any further transactions, that's probably the right time.
So let me try and pin you down. You don't have to be pinned down, but let me try anyway. Late 2026, early 2027 potentially?
I think what we'd want to do is put out a policy that then makes clear when people can see when that gets triggered. Because if you leave it opaque, then people just don't know what to expect. And we don't want to necessarily surprise people either, because then you lose a bit of the pop that comes with it. I think our intention is to really articulate a clear policy, and we've been sort of incrementally doing so, and we'll continue to do so. And then at a certain point in time, it's going to be clear to the market when we're going to trip over the sort of triggers we need to commence that dividend.
Okay, let me ask you a second and final question, which fits very neatly on, actually. You're already earning revenues from some gold assets, so do you expect other assets to become revenue producing in 2024? Talk us through what might happen in 2024 and beyond in terms of assets coming online.
Yeah, sure. This slide is the right one to show. So there are assets that turn on in 2024. In addition to the growth within the existing portfolio of cash flowing assets, Greenstone is a meaningful gold mine in Canada. It's been under construction for a while now, and they're flagging first gold in the first half of next year, and then intend to hit commercial production in the second half of the year. So that would be part of the light blue bar, that assets under construction with cash flow imminent, and a high degree of certainty to that eventuating. So Greenstone will turn on next year. One of the recent transactions we did this year in August on the Dandoko property, that one the operator had flagged the intention to commence production from trucking some oxide material from Dandoko to their currently producing mine. That's got less clarity in that they don't have to build the mine itself. They've got a currently producing mine with spare capacity in their mill. So because of that, and because this is a smaller property within a much larger company, there's less clarity on sort of how they're advancing towards moving into construction, but we still expect to see it turn on in 2024. And then we also flag on there the silver, precious silver royalty that we acquired this year in May. The operator had flagged, ideally they were targeting production from stockpiles before the end of the year. I think that's probably slipped to early next year. But then the commencement of production, the more meaningful production from fresh ore in the second half of next year, we expect that that's on track. So that would add a third cash flowing royalty next year. And then Sugar Zone was an asset that paused production this year. The operator is putting 100,000 meters of drilling into it, I think spending 35 to 40 million in capital, and sort of refreshing the mine plan. And it's like that should turn on sort of mid or the second half of 2024. So I think our expectation is that in addition to the assets that are currently producing, we should see around 4 assets that turn on next year alone. And as I flagged, 2 of those assets were acquisitions that we made this year. So the intent is to continue to make acquisitions, such that the bar that you currently see for 2025 and 2026 also sort of incrementally move up higher.
Adam Davidson, we're out of time, sadly. That's your half an hour up and gone. That was absolutely fantastic. Thank you so much.
Great, thank you.
No, that was a terrific presentation and a great Q&A. And thank you very much indeed for spending so much time on the Q&A. I think the investors really love that. On to our next company. Kavango Resources is a Southern Africa-focused metals exploration company which has recently received £6 million worth of investment from Pure Bond in return for 52.4% of Kavango's share capital. Ben Turney, Kavango CEO, will provide the rationale for the £6 million investment, and he'll explain who the investors behind the Pure Bond investment vehicle are. Kavango has refocused the business. Ben Turney and the team have refocused the business, completing the acquisition of 6 prospecting licenses in Botswana's Kalahari copper belt, where they've commenced a geophysical study by helicopter to further assess the copper-silver potential. And in southern Zimbabwe, Kavango has recently acquired 3 potential bulk mining gold projects around Bulawayo. I'm sure Ben will be talking about bulk mining a lot. And he's also taken a 15% share of Pambili Natural Resources Corporation, and they're operating in Matabeleland. They're TSXV listed, operating Matabeleland. Welcome back, Ben.
Thanks for having me.
It's a pleasure, Ben. How are you today?
Yeah, I'm very good, thanks, Donald. Moving house, as you know, so it's all been a bit of a long day.
Moving house, it's been a busy couple of days for you.
It really has, ahead of the move to Zimbabwe in January.
I know, ahead of a move to Zimbabwe, where you're putting your money where your mouth is, off to the land of bulk mining.
Absolutely. Brilliant.
Fantastic. Well, lots to talk through, Ben, so I shall leave you to it.
So thank you very much for taking the time to watch our presentation this evening. As usual, I just put the usual disclaimer up there for a moment. So Kavango Resources is listed on the standard list of the London Stock Exchange. And as Donald said in his interview, we've recently closed a £6 million financing that was completed at 1 pence a share with Pure Bond Limited. Pure Bond is the vehicle of the Consagra family, who are a pair of British billionaire brothers who've built an extensive business area over Southern Africa, including multiple interests, some of which are in the mining space. So the Consagra family has really thrown their weight behind Kavango as a result of Peter Winterby joining our board. Now, in the previous presentation that was just given by Trident, they talked about the Mimbula copper asset, which Peter founded back in 2015. He took that asset from an original $100,000 investment up to around about £1 billion investment as of today. And he bought into this asset at a time when both copper and Zambia were really sort of out of flavour, out of fashion. And what Peter's been very, very clear about since he joined the Kavango board back in January was he wanted to repeat the success that he had in Zambia in the copper fields. And we've focused our efforts very much as we reposition the business on the opportunity that there is in Zimbabwe. So as of today, we currently have 1.3 billion shares in issue, of which 60% are held in private hands. So between the Consagra family and between the board's holding of just under 8%, Peter and I recently bought nearly £600,000 worth of stock together in an open market transaction. Peter bought the lion's share of that, so just over £500,000 worth of stock directly in Kavango. I bought the remaining 50,000 at around about 0.8 pence per share. So far, we feel that we've been putting in place all of the building blocks for a very strong foundation for us to grow our business from. But so far, we think the market hasn't really picked up on that. Now, our management team remains unchanged over the course of this year. So our chairman is David Smith. He used to be the company's corporate lawyer. And we have a lot of technical talent and skills on our board. So Brett Grist is our COO. Brett has a lot of experience of field exploration in Africa and Western Australia. He's worked in a number of gold fields himself. And we have Jeremy Brett and Hilary Gumbo, who are our 2 geophysicists. They've led most of our strategy, our exploration strategy in Botswana, and are currently leading our efforts on the Kalahari Copper Belt. We also have on our advisory board 2 extremely experienced exploration geologists. We have Steve Smith in Zimbabwe. Steve has spent the last 15 years of his career working in Zim, having previously worked quite a senior level in Anglo-American. He used to be the head of business development in Tanzania before he moved over to Zimbabwe. And there isn't a man alive, I believe, who knows as much about the Matabeleland gold fields and the potential that there is down there than Steve. Meanwhile, over in Botswana, over the last year or so, we've been working very closely with Dave Catterall. Now, one of Dave's crowning achievements in his career was the discovery of the Zone 5 ore deposit in Botswana that's recently been sold for $1.8 billion to MMG, a Chinese firm. So it was in a company called Comacao and is now Chinese owned. We've been very fortunate to have Dave work very closely with us, and over the last year, he's really augmented and refashioned our exploration strategy, which most recently culminated in our acquisition of new exploration ground that I'll talk about in a moment. Now, in terms of our project portfolio, we still have most of our ground in Botswana, but our main focus there is in the Kalahari Copper Belt. We've just taken on the new ground, which we believe gives us the controlling interest over an entire geological system that we believe is highly prospective for the style of copper-silver deposits that have been so successful elsewhere on the belt. Meanwhile, in Zimbabwe, we have 3 projects currently, which we've negotiated options on. We took our first project in Zim in June, our second option in July, and by October, we already managed to get a drill rig into the country, and we're currently drilling our third target on the Hillside project, which I'll speak about in a moment. Elsewhere, we have the Kalahari Suture Zone and Ditau projects. At the moment, those are taking a bit of a back burner with us. We are still progressing them. They're quite complex, very demanding projects. They're geophysics-led, and we have some plans for bringing those back into life next year once we've executed our other plans in Botswana and Zimbabwe. So I'll begin with Botswana. Botswana really speaks for itself as an investment location for international investors. It's one of the most stable, most friendly environments for investing in the mining sector anywhere in Africa. There have been a number of very successful large-scale discoveries in Botswana and a clear pedigree, a clear track record of successful corporate transactions. I've just mentioned the recent $1.8 billion acquisition of Khoemacau by MMG, but before that, Sandfire Resources, the Australian company that's currently worth about 1.5 billion sterling, they successfully bought assets in the Kalahari Copper Belt from a company called Mod Resources. So as a jurisdiction, Botswana is a fantastic place to work. The greatest challenge, however, is the fact that the country is covered by 70% of Kalahari sands. And what that means is that when exploring, because the sand cover is so thick, that tends to obscure the regional geology, which makes exploration technically really quite demanding. We rely very much on geophysics in this jurisdiction. Now, so far, results haven't gone our way in Botswana, but the skills and the experience and the technology that we've developed have all been successful. What we haven't had is the good fortune of a drill strike. But this is where our new strategy in Botswana comes into its own. So as you can now see on this map, Kavango's ground is highlighted by the light blue section towards the southwest of the belt in Botswana. Our ground extends from the town of Hansi over in the east right up to the Namibian border. Now, this historically has been a very underexplored area of ground in the Kalahari Copper Belt because of the presence of some of these Kalahari sands. There was a feeling or an idea down to some incorrect historic mapping, these are maps going back about 60 years, where the Kalahari sands were estimated to be much thicker than they've actually turned out to be. So where in Botswana most of the attention is focused further to the northeast, where Zone 5 and T3 are, the region's major discoveries, the area that we've been able to secure hasn't actually been so widely explored. And you can see that through the size of the exploration licenses that we have. Each of those licenses that we've either applied for directly ourselves or that we've acquired are full 1,000-kilometre square licenses, and our total land package at the moment is just under 8,000 square kilometres. Now, what we're particularly excited about is the ground that we've just bought from ENRG, which tied our two licence blocks together. So previously we had the 4 licences out by the Namibian border and then the licences that were grouped around the town of Hansi. The recent acquisition from ENRG has tied the entire land package together. It's given us complete control over an entire prospective geological system. But more important than that, it's also given us 7 years worth of proprietary exploration data, including 5,500 metres of drilling that ENRG completed. Now, ENRG's previous exploration, it wasn't successful. They didn't actually make a discovery, but we believe that there was quite a lot that their team missed when they were working through the project. And one of the things that we've been working on very hard over recent months has been going through ENRG's data, tying it up with ours, and we've been pursuing what Dave Catterall has called a levelling up strategy, where we're currently looking to get a complete data set for the entire geological system that we're now exploring. We've got clear physical signs at surface of that this is a mineralizing system. So we have a number of the indicator elements that are telling us that there is copper beneath this ground. We also have indications from geophysics data, both surveys that we had flown previously and that ENRG had flown, that indicate we've got the right controlling structures that in the region have hosted other mineral deposits. So we're very, very excited about this ground. We're now flying an airborne survey, as Donald mentioned at the start of this presentation, and that airborne survey will provide us, we believe, with the final major data set that we need ahead of drilling to commence in Q1 next year. So our exploration now in Botswana has really been significantly upgraded, and we're looking forward to the results next year. Now, in terms of where we're actually focusing our energies, we have here a slide that shows what we now call the Karakubis block, which includes the 4 licenses that we previously held and the 6 licenses slightly to the east that we've just acquired from ENRG. We're particularly excited about this block. We believe it shows a number or demonstrates a number of the same similarities that were seen elsewhere in the belt in areas that led to discovery. What we're now focusing on is to zone in on the key areas ready for drilling. This is obviously still a very large land package. We've got very large scale targets to go for. So what our job over the coming months now to do is really to pinpoint where we believe we have the highest chance of delivering success with the drill bit. So we're taking our time to work through the gears on this. We're not talking so much publicly about this at the moment. We've very much changed our IR approach over the course of this year. So we're now going to be much more focused on delivering tangible results to the market. And we're looking forward to publishing the AEM survey results at the start of next year. And after that, announcing where we plan to drill. So moving over to Zimbabwe. Now, Zimbabwe is increasingly Kavango's main focus. The opportunity in Zimbabwe, we believe, is unmatched anywhere else in the world. This is a country which, let's be honest, isn't for the faint of heart. It's had a lot of trouble over the last 30 years economically. There's been quite a lot of uncertainty about being able to operate in Zimbabwe. And earlier this century, most of the majors all pulled out. Now, notwithstanding that, mining has successfully continued in Zim. And if you do ever get the opportunity to go down there, one of the first things that you'll notice is that what you read in the statistics about Zimbabwe being towards the bottom of the ranking tables in terms of its friendliness for being a mining jurisdiction, that isn't matched by what you actually see on the ground. There's a very surprisingly thriving economy, both in Harare and in Bulawayo, the town to the south where I intend to move at the start of next year. And this is all being driven by relatively small scale mining, together with some larger scale mining in some of the more prolific areas and some of the, like, for example, the platinum mines. Now, the opportunity in Zimbabwe is really underpinned by the fact that because of a lot of the economic troubles, the credit system in that country doesn't really function at the moment. So there isn't really any form of public markets, and external investment is almost non-existent. So this has created an opportunity for a well-financed external player to come in and really cherry pick some phenomenal projects technically. So one of the great things that Kavango brings to our efforts is, with the backing of Pure Bond, the 6 million that we've raised this year, and the indication of future support as well from our 52% shareholder, Kavango is now uniquely positioned to take advantage of this opportunity that we see in front of us, where you have 23 Archean greenstone belts that haven't really experienced any modern exploration. So we have a first mover advantage down there. There are some exploration companies who are active in Zim, but they haven't been anywhere near as active as we have. But one thing that is worth considering as well about Zimbabwe, and which points to its successful track record despite its reputation, is if we look at Caledonia Mining. Now, Caledonia Mining, they present sometimes on this webinar. They've paid 40 consecutive dividend payments. So that's 10 years worth of dividends that Caledonia has successfully managed to pay from their blanket mine, which is to the south of Matabeleland. So Caledonia has shown the way. They've shown it is possible to do business in Zimbabwe. It isn't the easiest jurisdiction, we know that. So where we've swapped the jurisdictional risk of Botswana for Zimbabwe, we've recognised that we need to build our business from the ground. So I'm going to be moving down to Zim at the start of next year to lead the business from the front line. But what we've swapped in terms of jurisdictional risk, we swapped the other way for geological risk, because the Matabeleland goldfields, they really are just a phenomenal world-class opportunity. And we believe that there are tens of millions of ounces in large-scale, potentially bulk mineable opportunities that are yet to be discovered. Wherever you go in Matabeleland, you see mining activity, from small-scale artisanal miners to larger-scale dump reprocessing, and there is some other larger actors who are starting to work down there, private money and Chinese money as well. So there is a huge amount of activity in this belt. You have a workforce that is very well educated, is highly motivated, works extremely hard. because of a lot of the economic troubles, there's been a shortage of regular work. So again, a company like Kavango coming into this space, we're able to offer experienced, well-educated, well-trained professionals the opportunity of regular employment. And that again is a key part of the first mover advantage that we as a business are looking to take. Now, in terms of our plans, we're focusing on the Philabouzi Gold Belt, Greenstone Belt, sorry. Now, the reason that we were attracted to Philabouzi in the first place, we were very much guided by Steve Smith and his experience. Now, in the mid-1990s, two academics produced a report on the Philabouzi Greenstone Belt, highlighting its potential for at least one, possibly three, world-class deposits. So a world-class deposit is one that contains 10 million ounces. Now, the nature of exploration in Zimbabwe is it's not like within other jurisdictions where you can apply for exploration licenses. The legal setting is more complicated than that. So what we are focusing on are historic mines that have a number of what are called gold claims that are stitched together in contiguous packages. So what you can see on this map, this essentially provides us with sort of our initial targeting around the Philabouzi Greenstone Belt. What you can see here are historic mines. There are 139 historic mines that between them produced 1.7 million ounces up until around about the 1960s. But most of this production was in the first half of the 20th century. Now, this area is very, very similar to the Western Australian goldfield belts that experienced the bulk mining boom in the 1980s. In 1982, Zimbabwe produced more gold than Australia, but where Australia's gold scene took off as a result of the new bulk mining methods that were introduced, Zimbabwe started to go through a number of its internal difficulties that meant that the sector and investment in the sector was substantially impaired. Now, the geology obviously over that time has remained the same. And what's particularly interesting about the Zimbabwe and the particularly in Matabele land, these goldfields exhibit a lot of the same geological characteristics as we see in Western Australia, which further strengthens our view that this is an area that is just ready, it's primed for a major gold rush. And through our Hillside and Nara projects, which are both located on this greenstone belt, we believe we have an immense opportunity in front of us to exploit. So I'll start with the Hillside project. Hillside,
if I could interrupt your flow, one more minute, Ben, one more minute.
Very, very quickly. So the Hillside project is 44 claims. We are currently drilling at Hillside. We are towards the end of our third hole. We plan to release assay results of that in the new year. We have an option on this project, which we have to execute by the end of January. We've got, we believe, at least one bulk mineable target within this project, and we're looking forward to producing the results. I'd like to talk, if we get the chance, about this at the end of the presentation. Please, Donald. Moving over to Nara, we've upgraded significantly our understanding of Nara over the last 3 months. We've done a lot of exploration on the ground. We haven't yet committed to drilling, but where previously we thought we'd be looking at a 500,000 ounce target, we've actually doubled our expectations there now up to a million ounce target at Nara. We've completed auger drilling of the dump at Nara, which offers the potential for near-term cash flow generation. And we've completed a complete geochem survey of the entire Nara project. So our plan is to drill Nara once we've completed drilling at Hillside starting in Q1 next year. So there we go, Donald. Thank you.
Brilliant, brilliant stuff, Ben, brilliant. So let's go back to the start then. Let's take you back to Powerbond. Powerbond Limited, the good news is they've got lots of money and they like you. So can you tell us, just put them into context for us and explain, for those who don't know who Powerbond are, just exactly who the two gentlemen behind Powerbond actually are.
So Purebond are the family vehicle of Bullo and Ramesh Kansagra. So they're brothers who've, over the last 50 years, have built an incredibly successful business empire. They have a lot of risk appetite, and they first met Peter Winterby, I think it was 2 or 3 years ago, and they invested into Mashiko, which owns the Mimbula copper asset. So they've been very close associates of Peter over a number of years now, and have had a lot of success through Peter's success at Mashiko. So Peter first introduced us to the Kansagras in October last year. They participated in our placing. So when we raised £3 million, they were our cornerstone investor. They took 1.5 million at 1.8p. I first then met the brothers in December through Peter, and we started to talk about further involvement. I think by that point, Peter then joined the company in January, got to understand a lot more about the inner workings of what we'd actually built at Kavango, but also the opportunity that we'd seen in Zimbabwe. Now, I first went to Zimbabwe in August last year, so we hadn't talked about it publicly at that point. So we started to have private discussions internally about sort of what our plans would be in the future. And then when I went to Zim in February last year, and then with March with Peter, we then reported back to Bulo and Ramesh and basically explained to them sort of what our vision was in April that year, in April this year. And I think they liked what they saw. So they felt that, you know, we as a team were backable. They've been immensely supportive. Earlier this year, when the KSZ drill, the Kalahari Suture drill, zone drill, went against us, our share price was trading at about 1.2 pence, and it halved almost overnight. We fell down to about 0.6 of a penny. Now, given that we were going through the whitewash process at this stage with the Consagras and that they'd agreed to do the deal at a penny, I think it's an indication of just how strongly they are supporting the business. That on the morning that we made that announcement, I gave Bulo a call, and his exact words to me were he didn't care how far the share price fell. We had a deal, we'd made an arrangement. He was sticking to that. He was a long-term investor and was going to support the company. So I can't think of another investor out there who would be any better to back a business like ours.
Okay, which takes us very neatly to Peter Winton-Bee, who is the other person that you would have backing the business, and he has backed the business. Now, he's the chairman of Mosiko, who, as you say, is Mimbula copper mine, a producing copper mine in Zambia, which is a great copper region. Peter knows knows Botswana, he knows Zim and Zimbabwe, and he's put £500,000 of his own funds into Kavango. So what is Peter? You've already answered this slightly. So what does Peter bring to Kavango, would you say? What are his influences and appeal?
Well, he's been a godsend. I mean, as simple as that. He brings a huge amount of experience. He's had a highly successful career. He sold a number of companies in extremely high value transactions to majors, and of course has had phenomenal success with Mosiko. The more I've learned about how hard he's fought with that company, and he really has fought, but the success he has had has been phenomenal. So having someone like Peter, who we can regularly call upon with his experience to help both guide our team and influence our strategic direction, but he also rolls his sleeves up, and like when we do need to get down into the trenches, you know, he's down there alongside us. So it's been great to work with Peter, learned a huge amount from him, and as you say, he's really just put his money where his mouth is. He's just bought on market over £500,000 worth of shares. I don't see any other directors in our space doing anything like that. So yeah, Peter really has been a phenomenal backer of the company, and yeah, he's a great person to work with.
Yeah, no, I'll give you that. That's pretty amazing, isn't it? What would you see as your priorities? What are the primary opportunities that you see, and what does Peter see? Do you agree as to, out of all these lovely assets that you've gathered, where should the capital allocation go? What do you do first?
So we're obviously a pre-discovery exploration company, so our focus has to be on drilling. What we needed to improve as a company is our drill targeting. I mean, that's absolutely clear. We drilled a lot of meters before Peter joined the board, but we didn't have any success yet. We were admittedly pursuing an extremely high-risk strategy, so a geophysics-led exploration strategy, is very, very high risk. The projects now that we're focusing on, both in the KCB, but particularly in Zim, we have a lot more geology to work with. We've now just picked up a huge amount of data as well from ENRG on our Botswana projects as well, which helps us de-risk those. But our focus as a company is on really building on the momentum that we gained previously and looking to drill as much as we can. So we've had the drill rig operational now in Zim since the start of October. We're coming towards the end of our third hole there. We're possibly going to drill a fourth hole. We're thinking about that at the moment on the Hillside project. We'll then immediately move on to drilling Nara. We've got really, really excited about what we've seen so far at Nara. We've just quite significantly upgraded our expectation level on that project. Then once we're complete on Nara, by that point, we should be ready to drill in the KCB. So I'm hoping that we'll be able to, as a company, transition straight from drilling in Zim to drilling in Botswana. And our focus really is on making that initial maiden discovery. Now, We do also have other opportunities that we're looking at for near-term cash flow generation in Zimbabwe. We've just announced our investment into Pambili Natural Resources. That's a first step towards transitioning Kavango towards becoming a mining company. So while our short-term focus is very much on drilling, making that first discovery, we are also putting in place the foundation ready to be able to transition into mining itself.
Okay. Are you going to move the drill rig from Hillside to Nara?
Yes, we are. So our field camp sits in between the two projects. They are about 20 kilometres apart from each other. So yeah, we'll be taking the drill rig straight from Hillside to Nara at the start of next year.
Okay, very exciting. You're planning to relocate to Zimbabwe. So remind us, when does that happen, Ben? And would you say Zimbabwe is a tougher mining jurisdiction to operate in than Botswana?
It's definitely a tougher jurisdiction to operate than Botswana, but it also has, a lot of benefits over Botswana as well. So where the sort of the corporate side of things is more difficult in Zim, the lack of a banking system that's really reliable is a particular challenge. What you do have on the ground is you have a lot of very motivated, very hardworking, very intelligent people who really are, they're desperate for regular work. And for us, that means we've been able to build a fantastic team already. I spent 2 months in Zim from August to the end of October, and the team that we've got in place, I have a lot of confidence is going to deliver for us on the ground. So I'm planning on moving there from the start of January to lead the business from the front line, subject to a possible operation I'm going to have on my ankle.
Okay, and you see lots of investment potential in Zimbabwe, would you say?
I think it's phenomenal. I mean, when you see the amount of money that there is in Zim that's sitting on the sidelines, one of the things that's really blown me away are these enormous cash warehouses that they have in Harare and Bulawayo, where there are billions of dollars that have been created. And because there's a lack of the banking system, this money is effectively just warehoused. It's under the proverbial mattress down there. And this wealth has all been generated from mining activity with relatively little investment. So while there is a lot of cash there, because trust is at a bit of a premium down in Zim, there's a country that, it needs to go through a bit more economic development. I think everybody down there recognizes this. A lot of that money is just sitting on the sidelines. So for a company like Kavango, what we are going to be able to achieve with our capital will have a multiplier effect compared to, for example, if we were to invest all of our capital into Botswana. What the locals have managed to build with such relatively meager funds that have been available to them really is already incredibly impressive. So I think in terms of the backing that we have and what we can bring to Matabele land as a serious investor that's really fully committed to helping grow the gold exploration and the gold mining sector down there is a great deal that we can achieve.
Okay, we haven't talked about it much, but you took a 15% share stake in Pambili. Could you tell us a little bit about that? That's my last question to you, Ben. We're just about there.
So I've known Pambili for a couple of years now. I've known the CEO for 2 years. He's based in London. I followed Pambili's progress quite closely because they took a project down in Zim. Unfortunately, they ran that first project remotely and they ran into a number of the issues that really I think sort of companies like ours need to try and avoid. Now, unfortunately for them, that meant that things didn't really work out with the first project. But what I really liked about what I saw about Pambili is how well they've run the PLC. So they've got a very tidy company that from a corporate perspective is extremely well run. They have all of the licenses in place necessary to do business in Zimbabwe. And John Harris has experience he's the CEO as a process engineer. So he brings a different skill set to the skill sets we already have within Kavango. So we've built a very close working partnership. The Golden Valley project that has recently gone into Pambili, this was one of the first projects that we were looking at as Kavango. The reason that we passed on this is because we found some what we believe are better, larger scale opportunities elsewhere. But Golden Valley itself is a fantastic project and perfect for the size of a company like Pambili. So we're looking forward to working with Pambili as they develop their in-country mining skills and expertise. We're looking obviously to learn a great deal from that, but also to leverage off that at the point that we start to bring our business through to production.
How interesting. That's a very good last answer. Ben Turney, CEO of Kavango Resources, thanks for joining us again tonight. That was really interesting. Christopher Nicholson, Managing Director of ACF Equity Research, and his colleague Renas Sidahmed will present recently published research on the rare earth sector, providing investors with a deeper understanding of the macro drivers for commodity prices and the competitive landscape in which the rare earth metals sector operates. Christopher has been a financial analyst for over 2 decades and trained at global US-based fund manager Legg Mason. He founded ACF Equity Research over 10 years ago, and Renas worked at both the IMF and the World Bank, as well as Mitsubishi Securities in London, and she's now head of ESG at ACF. Both are much sought after commentators, so we're very pleased to have them. Welcome, Christopher and Renas. Welcome.
Thank you very much indeed. Thank you. Ladies and gentlemen, we're delighted to have been invited this evening. 2 very good presentations running before us. We hope we can do the evening justice as well. So I hope that you can see our first slide, which is our introductory slide. Is that all clear? Can that be seen?
Christopher, we certainly can.
Okay, super. We're going to talk about rare earths as a sort of thematic piece, and then my colleague Renas is going to give you some insights into some of the challenges of modeling rare earths companies and some of the operational challenges that they also face. I think they probably won't be the usual things, so hopefully you will find it all very helpful. Just a couple of lines really on ACF. We are an independent research house, and our audience or our clients are the corporates. We keep it very, very independent by asking them to pay cleared funds up front for the year, and we always decline to publish only 1 note, so it's about 7 notes a year, so that investors are kept up to date. So if I go to the first slide, just a bit on us to give you context. This slide here shows the kind of portfolio managers that use our research and read it. So at the top, you've got companies with trillions and billions of dollars under management, and in the bottom row, you've got examples of companies that perhaps have 10, 20, 30, 40, 50 million dollars under management. And this is where our corporate clients are listed. So we have clients listed in all of these main markets here. So you've got North America, Europe, UK, Southern Africa, and Australia. And then we do consider ourselves to be a global company, taking advantage of the UK time zone. And our clients certainly consider themselves to be global. This is where they do their business. So they're everywhere, essentially, except for China and Russia, for obvious reasons. And then just very quickly, in terms of our distribution, 99% of all professional fund management terminals have access to our research. Bloomberg alone would give us 30 million plus potential eyeballs per annum across both their retail offering, which is their website, and across their institutional platform. And that's just one of many distribution channels that we have. So today's agenda, we're going to give an overview of REs from a sort of thematic research point of view. We'll take a little bit of a look at peer and valuation multiples approaches, and then the link between REs and ESG, at which point I'm going to hand over to my colleague Renas, as I'm sure you'll have heard enough of me by then, and she's going to talk about ESG valuation considerations and give you some insight tips on the challenges associated with modeling RE companies, which are quite specific, and the challenges and a couple of insights, I believe, Renas, and the challenges of RE mining in practice. Right, okay, so let me kick off with my piece. I will just share a little slide with you, which gives you a little bit of context. So the first thing to note is that rare earths, in spite of them, are not rare. There's a lot of them, 17 in total in the periodic table, and they have a relatively high crustal abundance at about 130 to 240 micrograms a gram. The issue is that economic concentrations in the context of contemporary mining technology are rare. And so this slide just shows you very briefly how rare they actually are. So the green elements are, if you like, exploration areas, and the red elements are production areas. You can see that there's not much outside of China and southern India, essentially. So the principal mined RE minerals, just as an overview, are bastanacite, monazite, and loperite. And then the softer mineral is the iron absorption clays, which are dominant in southern China. And also there are one or two spots for iron absorption clays in Uganda in Africa. And Renas may mention those as examples, for example. So then the principle, or I should say that rare earths are absolutely critical to the energy transition through their use in permanent magnets. So this is the key reason why they are worth studying, and it's worth looking at the companies that are attempting to extract, process, discover, etc. Permanent magnets, just by way of an overview, are transform mechanical energy into electrical energy. They are used in items including wind turbine generators, EV motors, etc., solar panels to some extent. And in terms of the actual permanent magnets, there are already 4 rare earths that are important. So neodymium, praseodymium, dysprosium, and terbium. I always struggle with the pronunciation, so apologies there. And included in the sort of production of permanent magnets, you also get some iron and some boron. So you may have heard of neodymium iron boron magnets, and you may have seen the abbreviation NDFEB, which refers to the same thing. So let's just get a handle on how important the market is. So in 2020, the RE market was valued at $2.6 billion approximately. We expect that to nearly triple by 2030. Permanent magnets account for 43% of RE consumption. And permanent magnets account for 90% of the global market value of the RE market. And China produces 90% of permanent magnets. So the slide here just gives you a little bit more color in terms of the, if you like, the use, if you want, by mass or by volume of REs. You can see there 43% for magnets. Catalysts are the next biggest usage at 17%, and then you've got metallurgy and glass polishing, etc., and battery alloys. So they are actually used in batteries as well to some extent. China and India dominate RE, what we call refined supply. So China controls close to 85% of global RE refined production, and this controlling percentage has continued to expand. India is a player too, and by contrast, India, as an aside, it holds about the world's 5th largest reserves of REs. So Chinese RE market dominance is a global strategic concern. And because REs are essential materials for electric cars, defense applications, and net zero electricity generation via, for example, wind turbines, governments such as the EU, US, Australia, and sectors such as autos are investing significantly in vertical integration, i.e. their own capacity, so their own supply chains. We predicted about 3 years ago in our global series of one-to-one briefings for the CXO suite of a large number of mining companies that in the future of mining companies would become vertically integrated. At that time, there were very, very few examples of this, but 3 years on, that concept has been thought of internally by other companies. I'm not suggesting that we gave them the idea at all, but it has come about that this is now a much more common idea, and there are examples springing up everywhere of vertical integration in mining. I mean, one of our ideas was that in the end, miners may never actually sell REs. They may only loan, lease, or rent them. That is material for a different presentation, of course, but it's an interesting idea. So we just touch a little bit on mine supply. So China currently dominates RE mine supply as well. Although we believe that China's dominance remains of critical concern, we also believe it is decreasing. So China's share of production of REs was estimated at about 57% in 2020. So this is digging it up from the mine. This is not actually processing it into a useful metal or a permanent magnet. Yeah, so we believe that production was estimated at about 57% in 2020, and that's down from 81% in 2016, which is a fall of about 4.6 percentage points per annum. And if you were to extend that decline rate between 2021 and 2023, that would bring Chinese mine supply, so the raw material, digging it up, below 44% of the global total. So this actually seems unlikely to be the actual case. But if it is, it may go some way to explain RE pricing behavior. It does appear, nevertheless, that China is heading for a significantly less dominant mine supply position. And we forecast that China's share of mine supply will have fallen below 50%, not below 44, but below 50% in 2022A, or once the data comes through. The caveat to all of this, of course, is that China can raise production volumes by 20% in a year simply by readjusting internal policy. So that does make forecasting very, very difficult, and it does mean you can see distortions which might throw one off track. But overall, we stick by the view that their dominance of the mine supply is decreasing. So let's just take a very quick look at demand. So Global Data, a research firm, predicts that global rare earth demand will reach 193,000 metric tons by the end of 23 and continue to grow at around about 4% CAGR between now and 2030. We, on the other hand, expect the demand to grow faster in the next decade, driven by clean energy applications where REs are critical components. We anticipate that many products using RE will reach growth inflection points, e.g., EV adoption, electric vehicles, wind energy, etc. In our base case scenario, we expect demand growth of around 7% CAGR until about 2030 to around 270,000 metric tons, up from approximately 167,000 metric tons in 2020A, and that number's according to Arafura Resources. So I hope that gives you a very brief overview of the sort of thematic nature of the sector. We have a recent thematic research report available on that, which we were happy to send to you if you want to subscribe to the site and just make a request in your email that you particularly want the RE report. Peer and valuation multiples. Let's have a quick look at this. In our rare earth peers, we use a mixture of companies. So we use both those that are still at the exploration stage, so they could be pre-strike, or they could have discovered something, but they don't have revenues. And we also look at companies that are revenue generating. Our focus is on companies that are involved in product or exploration for RE metals that would be used in permanent magnets, because it's 90% of the value of the market. And some of our peers, like Lynas Rare Earths, they are revenue generating, and then some of them are non-revenue generating, like IXR and Rainbow Rare Earths, which are in the exploration and development phase. And we also choose differences in scale as well, and we combine those and take a look at things. So one of the techniques that we use, it's not the only technique, but it is an important one, is that we compare the peers using multiples based on the potential resource expectations of MI plus I, so measured, indicated, and inferred. We then analyze the company's enterprise value. That has to be done specifically because there are different ways of treating debt, and it depends on the instruments and how they've raised money. But when we get the enterprise value, we then look at what the market gives to the value via the market cap. And then we compare those valuations on the basis of ton of resource and get a dollar value. And by looking at the two approaches closely, along with the other things that we do in valuation, we hope to determine which companies are potentially overvalued or undervalued by the market. In other words, what is the market misunderstanding? In many cases, and particularly for non-revenue generating explorers, there is a lot the market doesn't understand. The same is coincidentally true for biotechs, if you happen to also like biotech investment. Now, the thing to remind yourself of is that when the market doesn't understand, it considers that a risk. And markets downgrade the company and the sector valuations a lot more than they generally deserve. So the market effectively overshoots its markdown, exactly as it should if there is not enough clear, digestible information. It interprets this information asymmetry as a high degree of uncertainty, and markets particularly dislike uncertainty. Recalling that a miss is always punished more than a beat is rewarded. So rationally, the market overestimates the pain potential in the same way it underestimates the gain potential, except temporarily when the market suffers from FOMO, fear of missing out, where everybody gets extremely excited, and this leads to a pricing bubble, which generally bursts, well, always bursts, and that's generally a painful experience. So I hope that we've given you context of the valuation, and now we just tee up the link with Renas on the ESG side. One of the key longer-term advantages for RE, and it is absolutely integral and at the heart of the drive, the so-called zero carbon emissions strategy globally, which in turn is intimately linked to our thoughts on sustainability, ESG, and valuation. Renas, over to you.
Thank you very much, Christopher. Good evening, everyone. Right, so the ESG valuation consideration. The reason for having an ESG policy, preferably with metrics, is not just about the regulations. Although regulation is now catching up to with capital markets. So by 2027, the UK, EU, and US will make ESG reporting a requirement for both small and large companies. However, in our view, having an ESG policy can de-risk a company by lowering its risk elements, which in turn lowers the overall cost of capital, which then influences the DCF value, and ultimately can improve a company's valuation. This is ever more so important for companies that are involved in brown assets or mining, if they want access to investor capital at scale and or reliably. But it's also important because the many so-called responsible investors tend to steer away from mining companies because they're not actually aware of how mining and ESG can go hand in hand. So we have seen this personally, that mining and ESG can go hand in hand. For example, Kibo Energy, which is dual listed in London and Johannesburg, is shifting from brown assets into renewables by way of waste to energy. And then you have Ionic Rare Earths, which is listed in Australia. It's a rare earth mining company that is moving into magnet recycling space to create a circular economy. So now I'm going to move on to some of the challenges associated with modeling RE companies. I'll provide a few inside tips or choices to be considered. So we know rare earths are a set of 17 elements. They're not traded on the open exchanges, so more commonly over the counter, and the prices are very different. But what this means in practice is that there is little transparent market pricing. So it's not like trading oil or foreign exchange. So when you're modeling an RE company, one challenge is how to factor in the price of these elements over time and efficiently. So you could attempt the basket route, excuse me. However, that can create inaccuracies with the valuation. Because although there are different basket weights for each element, as I've mentioned, the prices do vary significantly. So instead, you would want to price each of the elements individually for each year of the model, i.e. the life of mine. This can be very time consuming. Believe me, I know I've just actually come out of modeling a rare earth company. But in doing so, you can avoid over or undervaluing the company significantly. It also means that the integral structure of your model is better because it is more flexible. Another challenge with modeling RE companies is deciding what to include or not include in the valuation. So in terms of an REE company, I'm referring to the actual MRE, the mineral resource estimate versus the potential MRE. And there's two scenarios. First one is, do you want to be overly conservative? In that case, the company is more likely to beat your expectations, and that will leave a lot of value on the table. The other scenario is, do you want to be more aggressive? But then in that case, you have to explain why the company failed to meet its targets, why you said they would, and then in the end, everyone ends up looking bad. For me as an analyst, I prefer to err on the side of caution. As we know, explorers are a zero-sum game. And until we physically see what comes out of the ground, we won't actually know what's there. So I'm going to move on to the last topic, which is challenges of REE mining. So a particularly tricky issue when analyzing REE is supply chain vulnerabilities, which are driven by several different factors. I'll come to those in a minute, but I just want to remind you that all sectors obviously have their own peculiar challenges when it comes to investing. But I can say that with mining, it is one of the sectors with extraordinary upside potential for explorers. But again, it is a zero-sum game. So factor number one, geopolitical concentration. So southern China and Myanmar mine approximately 98% of the global supply of REEs. China also has adopted a comprehensive set of policies that could limit supply growth. It is also busy navigating its relationship with the US and other democracies. So you've got single party or single ruler states tend to be somewhat more unpredictable in their decision making than democracies do. Factor number two, economic viability. The RE market is relatively small and volatile compared to other metal markets, so that can lead to fluctuating prices and price manipulation. So if you can manipulate the copper price, which is a relatively liquid market compared to many minerals, the potential for REE price manipulation in a highly opaque over-the-counter market is that much higher. And finally, factor number three, you have supply-demand equation. So for mining stocks, that can lead to prolonged periods of supernormal profits for investors and miners. It takes about 17 years from mineral resource discovery to mine production. However, technology is rapidly advancing, and the science of geology continues to get more effective. And like with many things, supercomputing and AI is going to drive that even faster. But the real lag comes from the rate at which policymakers are able to grant licenses. So I hope that AI will do a lot to speed that up, and of course, in a way that's safe for the environment. So in my view, we actually can have both. We can have shorter development timelines combined with much safer and more sustainable outcomes for the environment and the people working in the industry. And by that, I mean not just for the plants, the animals, and people on the ground, or indeed under it, but what manager wants to be all over social media for eternity because of an avoidable environmental or social catastrophe? Thank you.
Okay, Renas, that was brilliant. Thank you so much indeed. And Christopher, so you're both there for the Q&A?
Indeed.
Yes.
Who would like to take the first question? Shall we chuck this to you, Christopher? It's often said that lithium is the new gold, or indeed the new oil. I've used that line far too many times. I am a walking cliche. If so, where do rare metals actually fit in?
It's a great question. I'm slightly struggling with reigniting my video, so I'll just do that. I think it might be better. I think it's a very good question. You know, we talk to Western Australia chairman of mining companies, both on the lithium space and in other areas, and I think that, you know, where REE fits in, if lithium is the new oil, and I'm going to take that metaphor, is that basically, if you just have a storage system for potential energy, and you don't have any route to use the kinetic element of that to drive a motor, then all you really have is a bomb. So permanent magnets are the absolute linchpin to the value that is assigned to lithium as an energy storage component at any rate. And the reason why it's so important is because there are other competing solutions for utility scale long-term energy solutions, storage solutions, that can compete with lithium. And lithium is probably not the best solution for that anyway. But where it is a great solution is for transportation. So that oil analogy is a good one. But without REEs, or at least a substitute that would replace RE somehow in permanent magnets, it doesn't have any value as a transportation energy supply.
Renas, your thoughts?
Well, I would have to agree with Christopher on that.
Very good. Okay, let me pitch this one to you then, Renas. You can have this one all to yourself. So you have first dibs at this one. From an investment perspective, what are the different ways in which you can invest in rare earth metals? And is now a reasonable entry point? Is now a good time to be looking at rare earths and investing?
So from an investment perspective, I would suggest raise some capital and actually go exploring, go and see what's out there. So look out for equities that don't have a China/Myanmar supply chain. So we're trying again. The Western world is also now trying to do that as well by creating their own supply chain. So you want to look for equities that are vertically integrated. So as Christopher mentioned earlier, the UK, Australia, US, as well as automakers are moving into vertical integration. And one idea that we have had for quite a while is that critical metals miners will, in the end, never sell their metals, but rather loan or lease them out.
Very good. And Christopher, where's the funding going to come from for all this this vertical integration and this, the supply chain extensions and so on and so forth? It all sounds great in theory, but it's going to take, what, is it going to be private money? Is it going to be government money? Where's the funding going to come from?
Okay, so Donald, this is a very interesting area, and there are two aspects to this. You've got government backing will be important because in democracies, if we are going to rearrange the supply chain and we're going to go down this vertically integrated route, China still has a very important trump card. It can switch on and off huge amounts of supply. It's probably got a lot of stockpiled material as well, which means that it can go in and flood the market and cause very damaging price changes from an investor point of view. It also scares investors, so it dries up future capital, which then delays plans, and it all becomes a negative reinforcing cycle. And of course, that could well be part of the, shall we say, toolbox that China has in order to look after its own interests, which one can understand rationally that it wants to do that. But overall, that could prevent public markets from providing the necessary capital that will be required, as you correctly point out. So there is an important role for governments to play in making sure that there is some stability for investors, especially in the early days. But on the other hand, what China has created through its strategy is a fantastic investment opportunity. It's essentially created from nowhere a market opportunity that didn't exist. And that is attractive to investors who like high risk, but it is also attractive to governments as well for both political and geopolitical reasons. And because of the military applications of REE, there's that angle too. So yes, it requires government support, but we are seeing it. We are seeing policies in all the major economic blocs outside of China to try and develop these supply lines.
Yes, principally Australia and America, yeah?
Well, no, yes, I mean, that is very true. They, of course, are absolutely there, but the European Union has also really got stuck in here. I think that the ionic rare earths Belfast recycling plant is another example. I don't think that would have happened without European Union / UK commitment. The UK has signalled specifically that it would like its own critical metal supply chain on the island. So there are, I think, a lot of positive moves in those three regions. So the Australia region, North American region, and European region.
Do you have anything to add, Renas?
Well, in regards to funding, I just wanted to add that we touched upon the link between RE and ESG. So there is actually quite a significant amount of funding available globally. I mean, I think the number is about 2 or 2.5 trillion of ESG funds available to companies that obviously have an ESG policy or are on the ESG pathway.
That's a very good point, Renas. Okay, let me ask you the next question while we're with you. Are REE stocks mispriced today? And if so, why so?
So yes, fairly likely that is a yes. There is some market concern about upcoming substitute goods. So iron, cobalt, molybdenum alloys come to mind, but they are heavier. Others appear to be more rare than REEs or more expensive. and also the market is very excited about lithium, and given it is in the same ecosystem as REE, it is attracting some investor attention away from REE.
Okay, and Christopher, given the current very long timescales, you said 17 years. Does it really take 17 years from exploration to production? My goodness. Given the very, very long timescales for prospecting, can we expect a very tight supply schedule, that old supply-demand thing? And so a price spike in REEs can always be possible in the future. And of course, China turning on and off the tap and flooding the market.
Yes, I mean, this is part of what makes it an interesting dynamic, of course. And those dynamics also create enormous opportunities. I mean, the life of mine cycle is 17 years in a tier one jurisdiction. I mean, it can be longer in tier one. This is, so you average that out. But really, the real sticking points for nowadays for life of mine cycles are not life of mine, sorry, for exploration through to production cycles, this 17-year sort of average. The real sticking points now, particularly in tier ones, are the amount of time that it takes to issue the licenses. And so our view is the technology is moving forward all the time. Geology is improving greatly. I mean, we had a couple of examples hinting at that today in this webinar. But the other thing is that, as Renas pointed to, the AI combined with much more powerful computing has the ability to allow those issuing licenses to process information more reliably and quicker with better outcomes from an ESG sustainability point of view. And because it creates more transparency, it means that it's easier to manage investor expectations and management expectations. Managers will have to assume that the questions that perhaps didn't get asked in the past will be asked now, but both sides can prepare better and faster and more reliably. It's good for everybody. And in the end, ESG does reduce risk, so the returns are better for investors too. So you've got this possibility of contracting the mine cycle and having, at some levels, a less risky process. That leads to better returns.
Interesting answer. So, which takes us neatly to how central is REE to global sustainability? A big question.
Well, I would say it's extremely essential to global sustainability. I mean, without REEs, we would not be able to make the transition to net zero, as Christopher mentioned early on in his presentation. REEs are used in EVs; they're used in net zero electricity generation. So, unless we can come up with a substitute for REEs and their use in fighting climate change, I think at the moment there isn't a comparable alternative.
Okay, guys, we're not just out of time; we're spectacularly out of time. But how could I pull the plug on you? It's all absolutely such fascinating stuff. So, Renas, thank you so much for joining us. Christopher, thank you so much for joining us. That's the top team from ACF Equity Research. Thank you. And that's it from us after another great investor evening. Thank you very much to all our speakers for joining us live from around the world, and to those behind the scenes who helped them all get here. Likewise, many thanks to everyone from focusIR, London South East and London Broadcast Studios, who, as always, do such a terrific job. And that's it from me. A huge thanks to you all once again. But if you want to see the research note from ACF Research on rare earths, then we have put a link up to that report on the chat box. So just you go there and you can actually see that rare earths report from ACF. May all your investments in 2024 turn blue. Thank you and good night from us. Thank you.